You're listening to Audiology. Support this channel by becoming a member and be sure to submit your requests for topics in the comments below. Reaganomics, a term blending Reagan and economics and coined by Paul Harvey, refers to the economic strategies championed by US President Ronald Reagan in the 1980s. These strategies have been dubbed supply-side economics, trickle-down economics, or disparagingly as voodoo economics by critics. However, Reagan and his supporters preferred to describe their approach as free market economics. At the heart of Reagan's economic policy were several key actions: ramping up defense spending, aiming to balance the federal budget while curbing the growth of government spending, slashing federal income and capital gains taxes, cutting back on government regulation, and tightening the money supply to tackle inflation. The effectiveness and impact of Reaganomics remain a topic of debate. Proponents celebrate the end of stagflation, a buoyant gross domestic product growth, and a surge in entrepreneurship in the years that followed. On the flip side, critics highlight negative outcomes such as a growing income inequality, a culture of greed, a decline in economic mobility, and a significant increase in the national debt. In fact, under Reagan, the national debt tripled over 8 years. This reversed a post-World War II trend, turning a shrinking national debt relative to gross domestic product into a growing one. Before the Reagan era kicked off, the United States was stuck in a rough patch with lots of unemployment and soaring inflation, a situation often called stagflation. Criticism was mounting against the traditional Keynesian economic approach and models like the Phillips curve, which suggested a trade-off between inflation and unemployment. There was a political push towards stimulating the economy, which led to an increase in the money supply. Under President Nixon, attempts to control wages and prices were gradually dropped, and the United States started to build up its oil reserves to cushion against potential short-term crises. President Carter continued this by removing price controls on petroleum and establishing the Department of Energy. Many believe the end of stagflation came thanks to a focus on boosting productivity and a strategic reduction of the money supply over 3 years by the Federal Reserve, led by Paul Volcker. When Reagan entered office, he made it clear he was going to cut taxes, marking a significant shift from the strategies of his immediate predecessors. He lowered marginal tax rates, made the income tax code simpler, and furthered deregulation efforts. Over his 2 terms, the United States saw an average annual deficit of 4% of GDP, up from the 2.2% in the 8 years before his presidency. But despite this, the growth in federal spending as a percentage dropped from an average of 4% under Jimmy Carter to 2.5% under Reagan. Also, GDP per employed person and private sector productivity both saw healthier increases during Reagan's time compared to the period before him. Federal spending as a share of GDP was a bit over 21% with Reagan compared to 19% in the preceding years. Before Reagan took the spotlight, during the Nixon and Ford years, a mix of supply-side and demand-side policies was seen as quite out there by the more moderate Republicans. George H.W. Bush, competing with Reagan for the presidential nomination in 1980, famously slammed Reagan's economic plans as voodoo economics. Similarly, in 1976, Gerald Ford harshly criticized Reagan's idea to return a large slice of the federal budget to the states. During his 1980 campaign, Ronald Reagan spoke about taking the economy back to its roots, emphasizing the benefits of a free market and enterprise system that were popular before the Great Depression and changes introduced by Franklin D. Roosevelt's New Deal. Reagan found strong support among followers of supply-side economics, a school of thought that emerged as a critique of Keynesian economics, which focused on stimulating demand. A key argument from Reagan and his supporters rested on the belief that cutting tax rates could actually increase government revenue rather than adding to the federal debt. This idea was inspired by the Laffer curve, a concept from economist Arthur Laffer. The Laffer curve suggests there is a point where high tax rates start to hurt tax revenue because they discourage people from working or investing. Conversely, it also points out that very low tax rates can reduce revenue because they collect too little from the economy. Ronald Reagan also acknowledged the influence of the 14th century scholar Ibn Khaldun on his economic policy. In 1981, Reagan referenced Ibn Khaldun's observations on taxation, paraphrasing him to explain his approach. When a dynasty starts, it can collect a lot of tax from small rates, but by the end, even high rates bring in little revenue. Reagan's aim was to find the sweet spot, low tax rates that still bring in high revenues. In 1981, President Reagan took a significant step by removing the remaining controls on domestic petroleum prices and allocations, which was a major policy shift. Then, he went on to reduce a tax that had been imposed on oil companies' extra profits in August of 1981 and completely removed this tax in 1988. Right at the start of his presidency, Reagan made a big move to cut federal income tax rates through the Economic Recovery Tax Act of 1981. This law reduced the highest tax rate from 70% to 50% and the lowest rate from 14% to 11%. It also significantly cut estate taxes and reduced the taxes that businesses had to pay by $150 billion over 5 years. However, in 1982, facing certain realities, Reagan agreed to partially reverse these tax cuts, especially for corporations and to a lesser extent for individuals. This rollback effectively cancelled out 1/3 of the initial tax cuts. By 1983, Reagan introduced an increase in payroll taxes to fund Social Security and Medicare, and in 1984, another bill was passed to close some tax loopholes. As tax historian Joseph Thorndike pointed out, the tax increases in 1982 and 1984 were the largest peacetime tax hikes in history. With the aim of simplifying the tax system, the Tax Reform Act of 1986 was introduced during Reagan's time, spearheaded jointly with Congress. This effort was initially inspired by proposals from Democrats Bill Bradley and Dick Gephardt in the earlier years. The 1986 overhaul aimed for a simpler system by removing many deductions and reducing the top tax rates, all the while trying to keep the revenue neutral, meaning it wouldn't reduce the overall amount of money coming into the government. It marked a significant change in how taxes were imposed on income and capital gains, setting them both at a maximum rate of 28%. Interestingly, under Reagan's policies, the share of the federal revenue as a percentage of GDP saw fluctuation, dropping initially then rising back up towards the end of his presidency. This period also saw an increase in public spending, especially on defense, reaching levels not seen since the end of the Vietnam War, with military expenditures constituting a larger portion of the GDP and federal spending. Tax rates saw a dramatic change, with the maximum rate for the wealthiest dropping significantly during Reagan's presidency. The federal deficit also showed variation, peaking and then moderately falling, but overall the national debt increased substantially. This surge in borrowed funds shifted the U.S. from being the world's leading creditor to its largest debtor. Reagan himself expressed that this escalation in the national debt was his greatest disappointment. Analysts like William A. Niskanen and Roger Porter, who were involved in creating Reagan's economic policies, admit that while the administration achieved its major policy goals, the outcomes weren't as impactful as hoped. The most notable change was in the tax structure, with a decrease in the maximum tax rates and alterations in the treatment of business income, influencing investment types and rates. During the years Ronald Reagan was in charge of the budget, from the fiscal year 1982 to 1989, the average government spending was about 21.6% of the gross domestic product. This level of spending is one of the highest, closely matched by President Obama's time in office. Both Reagan and Obama dealt with major recessions soon after taking office. Also under Reagan, the national debt increased significantly, going from 26% of gross domestic product in 1980 to 41% by 1988. In actual dollars, it jumped from $712 billion to over $2 trillion, nearly tripling in just 8 years. The unemployment rate saw a rise from 7% to 11% between 1980 and 1982, but then it thankfully dropped down to 5% by 1988. Meanwhile, the rate of inflation fell from 10% to 4% within the same period, which was good news for the economy. Some experts believe that Reagan's economic strategies played a key role in sparking one of the longest periods of peacetime economic growth in the United States. Under his leadership, the economy grew by an average of 3.5% per year, which was a step up from the 2.9% growth rate in the 8 years before him. The average annual unemployment rate went down by 1.7 percentage points, from 7.2% to 5.5% even after it had previously risen. Employment outside of farms grew by 16.1 million jobs, slightly more than during the previous 8 years, though manufacturing jobs did decline. Reagan's era was notable for not increasing the minimum wage, a unique decision among presidents. Inflation was brought down from 13.5% in 1980 to 4.1% by 1988, partly because the Federal Reserve raised interest rates, peaking at 20.5% in 1981. These higher interest rates led to a recession that lasted from July 1981 to November 1982, during which unemployment reached 9.7% and the economy shrank by 1.9%. During Reagan's time, income growth slowed down for the middle and lower classes and sped up for the upper class. The misery index, a measure that adds the inflation rate to the unemployment rate, dramatically improved during Reagan's presidency, dropping from 19.33 to 9.72, marking the most significant improvement under any president since Harry S. Truman. In terms of household income, the percentage of American households earning less than $10,000 a year, adjusted to $2,007, decreased slightly from 8.8% to 8.3%, while those earning over $75,000 increased from 20.2% to 25.7%, indicating financial growth for some during Reagan's presidency. During Ronald Reagan's time in office, the average monthly job growth, focusing on jobs outside of farms, was about 168,000. In comparison, Jimmy Carter's presidency saw a higher average of 216,000 jobs added per month. George H.W. Bush's term had a lower 55,000 jobs per month, and Bill Clinton's presidency topped the chart with an average of 239,000 new jobs each month. When we look at the yearly growth rate of jobs, which is calculated by comparing the job numbers at the beginning and end of their terms, jobs expanded by 2% each year under Reagan. This is in contrast with Carter's 3.1%, H.W. Bush's notably lower 0.6%, and Clinton's 2.4%. Regarding the unemployment rate, the average during Reagan's presidency was 7.5%. This shows a slight uptick from the 6.6% average rate in the 8 years before him. However, from December 1982 onwards, the unemployment rate steadily declined, reaching 5.4% by the time Reagan left office. The participation rate of the labor force, which measures the portion of the population working or looking for work, rose by 2.6 percentage points during Reagan's 8 years. The preceding 8 years had seen a larger increase of 3.9 percentage points. An interesting point worth noting is that some analysts have highlighted that over 1 million jobs were seemingly created in September 1983 alone. While official records confirm this, it's important to understand the context. Nearly 700,000 AT&T workers had gone on strike and were marked as job losses in August 1983. Their return to work the following month after the strike's resolution led to them being counted as job gains, which explains the unusually high figure for that month. After the 1981 recession, the situation was a bit mixed when we look at the numbers. The unemployment rate was slightly higher on average, sitting at about 6.75% compared to the earlier average of 6.35%. Also, the growth in productivity wasn't as strong, averaging 1.38% compared to the previous 1.92%. Similarly, the amount of private investment in relation to the size of the economy was a bit lower, with an average of 16.08% of gross domestic product, down from 16.86%. However, by the 1980s, the tide had turned for the United States in terms of industrial productivity. The country caught up with its trading partners during this decade after falling behind in the 1970s. By the time 1990 rolled around, the share of the national economy, gross national product, accounted for by manufacturing, not only bounced back from its lowest point post-World War II in 1982, but also reached the heights of productivity seen in the 1960s. This was a time when American factories were operating at a very high pace. In terms of overall economic growth under President Reagan, the real gross domestic product, which is a measure of the economy's total output adjusted for inflation, saw an impressive increase. Over his presidency, the real gross domestic product grew by more than a third, which translates to an addition of over $2 trillion to the economy. The economy grew at an average rate of 3.6% per year during Reagan's 8 years in office, which is significantly higher than the 2.7% yearly growth rate during the 8 years before his presidency. Moreover, the real gross domestic product per person, which helps us understand how the economy's growth translates to individual prosperity, grew by 2.6% annually under Reagan. This was an improvement over the 1.9% annual growth seen in the years preceding his term. During the Reagan years, the average real hourly wage for people working in production and non-supervisory roles continued to drop, a trend that began back in 1973, but the pace of this decrease slowed. However, wages did not rebound to the levels seen before Ronald Reagan took office. Inflation was high during his tenure as president, which likely contributed to the decrease in workers' wages. Critics of Reagan point to his economic policies, describing them as neoliberal, as a key reason not only for the wage decline during his presidency, but also for wage stagnation in the subsequent years. Looking at income and wealth, the median household income, when adjusted for inflation, grew at a rate of 5.5% annually during Reagan's time in office. This was a slowdown from the 8.5% annual growth rate observed in the 5 years prior to his presidency. From the beginning to the end of Reagan's presidency, the real average income for families increased by $4,492, which is more than the $1,270 increase observed in the 8 years before he took office. After a decrease from 1973 to 1980, the average real personal income rose by $4,708 by the year 1988. Additionally, the overall wealth of households, not adjusted for inflation, grew by an average of 8.4% each year during Reagan's presidency, slightly slower compared to the 9.3% growth rate during the previous 8 years. As for poverty levels, the percentage of Americans living below the poverty line rose from 13% in 1980 to 15.2% in 1983. Fortunately, by 1988, this figure had returned to 13%. Homelessness became a highly visible issue in America's city centers during Reagan's first term. Critics argue that Reagan's significant reductions in housing and social services spending were key factors that nearly doubled the homeless population between 1984 and 1987. Towards the end of his presidency, Reagan shared his views in an interview with David Brinkley, saying that for many homeless people, living on the streets was a personal choice. He noted that despite the availability of shelters, some people still chose to live outside, attributing this preference to a variety of reasons, including mental health issues. Reagan mentioned that a significant number of homeless people had mental health problems, partly blaming lawsuits by organizations like the ACLU against mental institutions for this situation. During the Reagan administration, from start to finish, federal income from taxes grew significantly, jumping from $599 billion to $991 billion, which is a 65% increase, while the government's spending shot up from $678 billion to $1,144 billion, marking a 69% increase. A report from the Joint Economic Committee of the United States Congress in 1996 highlighted that in Reagan's time, and extending into 1993, the top 10% of income earners ended up paying a larger share of income taxes to the federal government. On the other hand, the bottom 50% of earners saw their share of income tax payments decrease. It's interesting to note that while personal income tax as a portion of the gross domestic product dipped from 9.4% in 1981 to 8.3% in 1989, payroll taxes actually went up, moving from 6% of the gross domestic product to 6.7% in the same period. Regarding tax receipts, both the Congressional Budget Office and the Reagan administration predicted that with the proposed Reagan tax cuts, individual and business income tax revenues would fall below what they would have been without those cuts, to the tune of about $50 billion in 1982 and reaching $210 billion by 1986. A 2003 Treasury study pointed out that after the Economic Recovery Tax Act of 1981 was put into action, revenue saw a significant decline, about $111 billion less in the first 4 years, or almost 3% of the gross domestic product annually, compared to what it would have been. While other tax legislation had mixed impacts on revenue as a percentage of gross domestic product, it's clear that following the 1981 Tax Act, the overall tax burden as a share of the gross domestic product dropped, leading to a bigger deficit since spending remained high in relation to the gross domestic product. Despite the dip in 1982, federal tax revenue increased every year of Reagan's presidency at an average rate of 6.2%, which is slightly slower compared to the 10.8% growth rate in the 8 years before his term. The impact of the 1981 tax cuts, which reduced revenue relative to what it would have been, was somewhat balanced out by increases in Social Security payroll taxes. These increases began with legislation enacted by President Jimmy Carter and the 95th Congress in 1977 and were furthered by Reagan in the early 1980s to counteract the use of tax shelters. A look at the numbers shows nominal tax receipts grew from $599 billion in 1981 to $1.032 trillion in 1990, a 72% increase in current dollars. Adjusted for inflation to $2005, this was a 20% increase in tax receipts to $1.5 trillion. Ronald Reagan took office in January 1981, and the first budget he was responsible for was for the fiscal year 1982, with his last budget being for 1989. Under Reagan's tenure, the amount of federal debt held by the public almost tripled in terms of actual dollars, jumping from $738 billion to $2.1 trillion. This significant increase resulted in the United States going from being the world's biggest international lender to becoming its biggest borrower. Reagan himself expressed that this surge in debt was his greatest disappointment during his time as president. Looking at the federal deficit as a share of the overall economy, it went up from 2.5% of the gross domestic product in the fiscal year 1981, reaching a high of 5.7% of GDP in 1983, before it slightly decreased to 2.7% by 1989. Regarding government spending, the average total federal outlays were 21.8% of GDP from 1981 to 1988. This was higher than the average of 20.1% seen from 1974 to 1980, and was the highest rate among all presidents from Jimmy Carter through Barack Obama. When it comes to revenue, the total federal revenues averaged 17.7% of the GDP from 1981 to 1988, compared to an average of 17.6% GDP from 1974 to 1980. Specifically, the revenue from federal individual income taxes dropped from 8.7% of GDP in 1980 to 7.5% in 1984, before slightly recovering to 7.8% by 1988. During Ronald Reagan's 8-year presidency, after-tax profits for corporations increased at an annual growth rate of 3%. This was a slower pace compared to the 13% annual growth rate seen in the 8 years before he took office. The Standard & Poor's 500 index, a measure of stock market performance, saw a significant rise of 113.3% over the 2024 trading days of Reagan's presidency. This contrasts with a much smaller increase of 10.4% during the same number of trading days before his term. Furthermore, the portion of the U.S. economy devoted to business investments, which is reflected in the gross private domestic investment component of gross domestic product, decreased slightly by 0.7 percentage points under Reagan. This followed an increase of 0.7 percentage points in the 8 years before his presidency. Under Ronald Reagan's presidency, the portion of the economy taken up by federal government spending increased a tiny bit, by 0.2 percentage points. This was after it had actually decreased by 1.5 percentage points in the 8 years before he took office. When it comes to the number of people working for the federal government, there was a slight increase of 4.2% during the 8 years Reagan was in charge. This was a bit less than the 6.5% increase seen in the previous 8 years. During his campaign, Reagan made a bold promise to make the government smaller. He planned to do this by getting rid of the Departments of Energy and Education at the cabinet level. However, that didn't happen. Instead of cutting back, Reagan actually added to the cabinet by upgrading the Veterans Affairs from an independent agency to a cabinet-level department. Starting in the 1970s and picking up pace in the 1980s, the gap between the rich and the poor in the United States kept getting wider. According to a 2006 report from The Economist, this shift began after the oil crisis in 1973, which led to a slowdown in how much productivity was growing. Soon after, by the start of the 1980s, the difference in income between the rich and poor started to noticeably increase. The Congressional Budget Office provided some numbers to paint a clearer picture. The portion of income going to the top 1% of earners, before any government transfers like Social Security or taxes, increased from 9% in 1979 to its highest at 13.8% in 1986, before dipping slightly to 12.3% by 1989. After considering government transfers and taxes, the income share of the top 1% still went up, starting from 7.4% in 1979, reaching a high of 12.8% in 1986, and then decreasing a bit to 11% in 1989. Conversely, the bottom 90% of earners saw their share of total income decrease by 1989 compared to 1979, showing how the economic gains were increasingly concentrated at the top. A study by the Cato Institute, a libertarian research organization, found that the U.S. economy generally did better in several key areas during Ronald Reagan's presidency compared to the periods before and after his time in office. Specifically, factors like family income, interest rates, inflation, and unemployment all showed significant improvements. However, savings rates dipped, and productivity didn't rise as much as it had before Reagan took office. The study also downplays the role of Federal Reserve policies under Paul Volcker, appointed by President Carter, in curbing the inflation of the 1970s. Economic analyst Stephen Moore, in this analysis, praised Reagan's 1981 tax cuts as a foundation for economic growth during the 1980s and 90s, marking a period of significant prosperity and increase in wealth in America. Moore attributed this success to Reagan's policies, which included reducing federal income tax and government spending, promoting free trade and careful monetary regulation. Milton Friedman, a renowned economist, simplified Reagan's economic approach to 4 principles: reducing taxes, easing regulations, controlling government spending, and maintaining a non-inflationary monetary policy. Despite not fully achieving these goals, Friedman recognized Reagan's significant progress. The Tax Reform Act of 1986 is noted for adjusting the alternative minimum tax, which lessened deductions and lowered nominal tax rates for the wealthy while increasing rates for lower-income earners. This move, despite its intention to simplify the tax system, brought about challenges, making it hard for Congress to enact reforms due to the alternative minimum tax's revenue. Paul Krugman, another economist, attributed the economic upturn during Reagan's tenure to standard business cycles and monetary policies rather than Reagan's policies, criticizing the era for widening wealth and income inequality. In terms of government spending and public debt, both saw increases during Reagan's administrations, with public debt rising significantly as a percentage of gross domestic product, a trend that challenges some claims about the effectiveness of Reagan's economic policies. Interestingly, while Reagan is often celebrated for deregulation, experts like William A. Niskanen and economists Raghuram Rajan and Luigi Zingales point out that many deregulatory efforts began before Reagan's presidency. Despite this, Milton Friedman argued that Reagan's presidency was marked by a decline in regulatory growth, as indicated by a decrease in the Federal Register's page count, a measure some critics say is too simplistic. Further analysis finds contradictions within Reagan's deregulation efforts, such as the increase in trade barriers and regulatory measures contrary to the deregulatory narrative. Despite this, studies show that the Reagan administration still published a significant number of regulatory rules. Thanks for watching. Share your thoughts in the comments and subscribe for more content.